Hi everyone. Okay, so we can hear properly. It's working.
Yeah.
Good. So yeah, we are here to talk about diversification in crypto, in portfolio, and overall market structure. So I'm Szantyr, managing partner at Blockstone. We do believe in diversification. We run a multi-strategy fund, multi-manager. The idea is to not put all your eggs in one basket. We have 7 strategies running now, 2 Bitcoin yields, offering to investor in order to get higher risk-adjusted return. And so I'm joined by my panelists, and I will let them introduce themselves. Go ahead.
Well, hello. The great Howard Marks said, investment success comes not from buying good things, but from buying things well. My name's Jennifer Murphy. I run Rooted Digital Assets with my partner Max. We run liquid token strategies, and we focus on buying things well, which is another way of saying buying low and selling high. So it's natural. All of us like hyperliquid when it's in the 40s, and it seems very successful and attractive. But buying hyperliquid in the 40s is probably not a recipe for investment success. So we focus a lot on how we buy. We like to buy good things, but only in terrible markets. So for us, today's a great day. There's a lot of potential buying opportunities.
Good. Thank you.
Hi, everyone. My name is Román González. I've been managing a hedge fund here in Madrid, the first one that was regulated by the Spanish regulator. And we are starting to create new products, new baskets. We focus in baskets, in portfolio diversification, and low correlation between assets, low volatility, and how to manage a really well-adjusted risk portfolio. And I think that's really good with the topic we are trying to talk here about. Thank you.
Hello, my name is Rémond Timmerman. I'm head of investor relations for HODL. We're a digital asset manager based in Rotterdam. We currently have 3 different types of funds. We do venture capital fund, also a directional fund, which is fundamentally research, but we also use quantitative overlay to get the right timing in the market. And we also have a market and delta neutral fund. Happy to be here, and I hope you enjoy.
Hi everyone, my name is Marco Javarone. I'm a theoretical physics, now working as a R&D director at Nodiens. Nodiens is a data intelligence platform to support investors, to support crypto enthusiasts and professionals navigate the complexity of Web3. How do we do that? Through computing and try to assess risk-based metrics and to inform users about that. And we achieve this goal. We try to achieve this goal just working out metrics and indexes that allow to quantify risk and related phenomena in the crypto market.
Great. So we got a diversified portfolio manager, different strategy, different ways of making money. And of course, today, diversification is key with what happened last week and what is happening today. What we can see in digital asset, like every coins are correlated, let's say 1-to-1, kind of, moreover when the market is collapsing. So how do you play diversification? Let's start with you, Jennifer. So we were touching on the prep call that it's not only about crypto anymore, and maybe it's interesting to touch on that part.
Yeah, when we started, we were coming from equity markets in the United States. We looked at the S&P 500, which is the most invested in index in the world. The S&P 500 is organized by sectors: financial sector, tech sector, utility sector. So that was the way we organized our diversification in crypto, by sectors, currencies, protocols, DeFi, utilities. And we diversified by those sectors. And when we had markets like today, it didn't matter at all. It didn't provide any protection against downside, that sort of diversification. So what we began to focus on are other types of diversification, like, for example, volatility. So we own a barbelled portfolio, generally speaking, of lower volatility assets, like, believe it or not, Bitcoin is among the lowest volatility assets in crypto, but also things like the carry trade fund from Superstate, for example. which provides lower return, but a lot of ballast in a bad market like this one. And we barbell it with high volatility, but good fundamental businesses, token projects like Metaplex, like Maple, things like that, that their prices jump around a lot, but their underlying fundamentals tend to grind it out. And then in the middle, as you're alluding to, Carl, we trade things. So, for example, in the tariff tantrum early in this year, stocks went down a lot more than they have in the past in a very short period of time. And so we bought stocks in the portfolio for the first time. We bought Coinbase under $150. You know, it's over $300 today. Just tremendous opportunities, sort of token-like return opportunities in equity markets. And that's become a form of diversification for us as well.
Thank you very much. Román, so you relied on 90 days rolling correlation, right, when you built your portfolio, if I recall. And so how do you see how does the correlation between stocks break, and how do you build your portfolio in that way? And how is it truly diversified on your side?
Yeah, that's right. As Jennifer said, once everything is dropping and the bear market comes back, the correlation between assets go to one. So all the things are. It seems like all the crypto are going together. So we think we are still in a bull market, by the way, because we see some decoupling between assets. There are really bad days and bad weeks we are seeing, but only punctual moments where you see high correlation between assets. So we are watching now some decorrelated assets like Binance and other ones that are behaving different from the main ones. But yeah, that's right. You need a systematic way to calculate that decorrelation between assets. And in crypto, everything is changing so fast that with 90 daily working days, we are really fine with that. So we are analyzing the last 90 days of the crypto prices and watching in a systematic way all the correlation between them, the volatility that they have, and trying to build portfolios. The efficient one, we are calculating an efficient frontier using Markovit's approach and trying to find the best portfolios in terms of risk reward, attending at those 90 days of prices.
Thank you. And so you had a book which was 20, 30 coins. The title of this correlation is to diversity. Can you tell us more about that?
Yes, of course. I think what we've seen in the last couple of years is that the market is changing pretty quickly. I think if you look at more professional players entering the market and also institutional players, sorry. We've seen a lot of change in how the market behaves. We used to have 20 to 30 positions in our directional portfolio. We used to do more long-term buy and hold, which worked perfectly fine in earlier cycles. What we see in this cycle, it's quite different. So currently we have Bitcoin as a base, which is our largest position, and we have altcoins, some also for longer-term holding, but we're now trading it more actively. So we're taking profits early. We move that back into Bitcoin and or stable coins when we think the market is overextended. And so we have a much more agile approach now to the market.
Yes, Marco, for you. So, which non-price maybe funding rates or market risk best flag for this diversification?
Well, I mean, when we talk about diversification, there is a first initial difference that we have to consider between traditional finance and crypto finance. Because in traditional markets, typically diversification relies on the sectors and geographical exposure. So you can create a diversified portfolios, maybe investing in assets belonging to different sectors and so on. But with crypto, it's everything different. Why? Because many tokens rely on the same network. They undergo the same liquidity, most of the time Nodiens is try to understand this phenomenon from different angles. That's why we rely on different kinds of data, like community and social data, ESG-like data, and financial data. And combining all this information, extracting information, quantifying information by indexes, then it's possible to get some signals and to get some insight on how diversification can be actually achieved. So going beyond pure price correlation. So this is the actual difference and the approach I think we need to take care when we want to diversify a portfolio.
Yeah, you want to say something, Jennifer?
Yeah, you mentioned funding rates, Carl. And we used to, in the past cycles, we would, are you familiar with CoinGlass? They have a funding rate heat map. I would pull that up every morning and look at it. In the last cycle, the funding rate heat, this was the top sign, but we didn't know it at the time. The funding rate heat map had to add new colors because the hot colors couldn't reflect how high the funding rates were. So they had to add new colors to the chart. That was the top of the market. Now the funding rate is just, the heat map is just blue every day. It's just blue, which means there's no heat. But obviously in the markets, that's not true. So what we found is you have to go to Hyperliquid and the perp dexes and look at open interest on perpetuals, because that's where the leverage is hiding. It's not visible in funding rates this cycle, at least as far as we can tell.
Yeah, so the whole challenge when you run long-only strategies is diversification. We try to find ways around, but what we see is when, excuse my French, the shit hit the fan, everything is going down and very highly correlated. What about diversification in terms of strategies? Maybe Rémond, you can speak about what you do. So you're a multi-strategy shop, digital asset management. So you also run delta neutral. How does it look for you between the book and when you speak with investors? How do you diversify the allocation between the market neutral part of the book you're running and which kind of strategy you're running there?
Yeah, we look at the market delta neutral strategy. We started that in March this year, so we're pretty still starting up the fund. But I think diversification in strategies there is key. In the end, you want to have a portfolio that is that has strategies that are uncorrelated to each other in terms to be able to get a better risk return profile on your fund. So, for instance, we're running funding ARB as well as cross-exchange arbitrage, and we have plans to diversify more into more strategies to get a better risk return profile.
And I have a question for you, Román. You run ETP, right? And the market is trading 24/7. How you deal with the market during the weekend? How do you deal with that on your side? Because you can't do anything during the weekend, can you?
Yeah, that's right. I mean, we are a long-only fund in crypto. Our view is that this new asset class is going to bring you 35 plus yearly returns in the coming 10 years. That means you are going to multiply your money by 28 in the part of your portfolio that you decide you are allocating to crypto. That's our view. I mean, we are not high-frequency traders. We see plenty of volatility in the weekends. I think you don't need to act most of the time. We cannot, but for sure, I really think that if you are not a high-frequency trader like us, you don't need that. So we are really nice. We are really comfortable using European crypto ETPs. We really think that that's the way where an institutional investor should go, because you are also delegating the main risk of crypto that is, in our opinion, custody. So you are delegating the huge risk associated with crypto in a really good, proper, and best-in-class custodian solutions. The second risk is market risk, for sure. And for that, we try to think of crypto as, okay, this is not equity. You cannot put you can manage a crypto equity fund with a cap of 3% in a single equity. That you can manage a fund like that, it's okay. but every time we see like a cap of, let's say, 25, 30% in any given asset in crypto, we really think that's a mistake. So in terms of diversification, we think about there is no cap. That was a really interesting conversation with regulators because, you know, they love putting caps in everything. And when we told them, okay, we need more than 30% sometimes waiting in Bitcoin or Ether, they get really scared. But that's the way you need to think about diversification and cash for sure.
Okay,
Thank
you. So you touched on something. So diversification, it's also coming from the plumbing, all the infrastructure we deal with. And we can't speak in... we can't trade crypto on a centralized venue and trading. We need to have this diversification between the prime, between the exchange, the custodian. Marco, do you want to touch on that? How the diversification is really important, moreover when you got situation and a big meltdown like last week?
Yeah, of course. One of the aspects to consider, for instance, is the natural concentration that we can observe in the crypto market. Concentration in terms of having a few networks that actually are the main one driving and having the longest resilience in time, like BTC, ETH, and so on. And at the same time, when we want to diversify a portfolio, we have to take this into account. And we need a tool in order to assess also the other assets that can be related to emerging project. In order to assess the quality of emerging project, then you need to measure quantities like the specific project a token is related to, how good is this project, what kind of solution is offering to users, and why it can be considered particularly of interest for a community of people. Because with the digital asset, we not only have a project with offer solution, but we have also meme coins that are more social-like, that are more affected by social-like dynamics and so on and so forth. So I think that concentration of the digital asset, that is something we have to deal with, that is not a bug, but at the same time can be an issue from the infrastructural stability of the whole system, is something to take care, but is somehow expected, because being a complex system, the crypto market, it has a few tokens that are much more relevant than others, and there are many others that are a little bit less. So if you want to think about that in statistical terms, it's really not been described by a typical Gaussian behavior where more or all the entities behave the same way. They typically behave in a different way, with the shape, with the statistical shape that is much more heterogeneous, that is a hallmark of complexity, not only in the crypto system, but also when we analyze social network, for instance, where we have typically normal people versus influencer, when we analyze biological network, transportation network, and so on and so forth. We need to be aware of the strong differences, and then we need the right tool in order to discriminate among the emerging project and the emerging tokens, what are those that actually deserve more attention, that can contribute to actually diversify our portfolio, that has to include some of the main network as well as some of the new ones. So balancing correctly the risk, but the risk need to be quantified. And I think that there are different angles to do that, that cannot be related only to numbers, but need to be looked into inside the communities of people, because at the end there are people talking about a specific asset, so we need to pay attention into that direction.
Thank you very much. And Jennifer, so we speak about diversification, about universe, about ecosystem in crypto, but also, so we got Coinbase, we got the miners, we got infrastructure company which are listed. Which kind of alpha it generates within a portfolio? How do you see that, okay, trading now in the proxy crypto traditional market is bringing value? Circles did 8x on the IPO, so obviously when you, it's really outperforming everything out there. So Bitcoin used to be like a week ago 20% up on the year, should be flat or maybe losing money now. So how can you, with traditional market analytics, get better return on your crypto hedge fund?
You're right that the theme this year has been the equitization of crypto. The traditional finance finally arrived in crypto, the investment banks, portfolio managers, especially in the United States, but I assume globally. But they didn't arrive the way we thought. You know, we thought they were going to come with us and own tokens, but they only want stocks, it seems, or ETFs. So it became where prior to 2025, we would focus a lot on things like ecosystem diversification, whether we had exposure to Base, to Solana, to Ethereum, et cetera, because that was a way to provide diversification and alpha. But this year, it's all about ETF flows. It's all about IPOs. You know, there have been 8 major IPOs in the U.S. stock market this year. 4 of them are down tremendously, 60 to 70%, and 4 of them are up similarly. And you mentioned Circle, and in our view, Circle came public on June 5th at $31 a share. Today it's, I don't know, $130, something like that. That touched off the equity mania for crypto, in our view. And so you had the digital asset treasury companies accelerate along with ETFs and IPOs, which continue. And those flows are what tell you the story of what's happening. So, Carl, we're having now to, up until the last couple of weeks, having exposure to tokens that could have an ETF, that could have a digital asset treasury company, that could have a related IPO was a great thing. And now that all seems to be flipping over. And so we have to be looking at what do we own that's going to be on the receiving end of those outflows from ETFs, outflows from the digital asset treasury companies, or certainly lack of buying. So it's a big area of analysis for us.
Very interesting. Thank you very much. So what do we see on our lens? So we started allocating in the digital asset space back in 2017. And 2018, we were looking to build market-neutral portfolio during the bear market, which was nearly impossible back then because even administrators were not dealing with anything else than Bitcoin. So to have an institutional grade fund-of-fund product was very complicated. What we see now is you have like 5 main buckets of strategy which are run in the space. So you have people running market neutral, so the basis trade, but you can't just do that because, of course, like you leverage it. Last year you run 6% vol, you have 30% return, which is great, but this year you're flat or you lose money if you're just not able to have a diversification, multi-strat, doing cross-arb arbitrage, for instance, cross-exchange arbitrage, sorry. Then you got people running long-short momentum, all the quant strategy. Same thing, things which work very well in certain market structure and become a way more challenging in market like we have this year because what we see is a big inflow are coming to Bitcoin mainly. Ethereum a bit since the summer. Ethereum went up 50%. And we got this traditional money which is looking for crypto proxies. But the momentum is playing well in days like last Friday or like today, where they can pick the trend and save your portfolio. And the overall, if you got a long book which is going down 10% on the day, those strategy enables you to get some profit on the end. So diversification really does make sense. Then, same thing in the market neutral space. It's very challenging this year. And if you're not able to pivot to DeFi and to get some yield there, you are really underperforming your peers. So you need to look at that as well. And then the last piece is the market making, which is like really the sweet spot where it's nearly always making money unless you get caught in something wrong. So all of these things are to be looked at. And but maybe then we can speak about not only diversification of portfolio, how the portfolio is constructed, but also in terms of service provider, how you diversify the risk, because our role is to be risk managers. This is what we offer to investors, to make sure that money is safe. So with a diversified custody, diversified prime to get liquidity, you don't want to trade only on one platform and to be shut down like it happened last week, for instance. And so how do you deal with that in-house? How many service providers you use? How do you leave more than 50% of AUM on one exchange, one custodian? Who want to start? Marco?
Okay, if we are talking in terms of what sort of services is provided by new tokens, new project, and then the lifetime of this project, I think is a topic that can be related to survivorship of this token somehow. It's somehow related. And if we observe from this perspective the crypto ecosystem, and we find that there are some tokens like the most famous one that are able to survive over time, different cycles, and then there are continuously new ones that are launched in order to fix some problem, in order to get a new technology, in order to offer a new service as well. We need to analyze the way these emerging projects are able to fit the market at the right time or not. The crypto market is somehow, from this perspective, let me say, that can be modeled using even the Darwinian theory of evolution, assigning a sort of fitness to each token, the way it fit the market, the way it fit the system. And in order to calculate that in the very same way, it can be analyzed in other contexts, like in ecology, probably, we need data. So we need to collect enough data, we need to collect data and then extract information and to quantify all these aspects. So it's not the strongest typically, but it's the one that with the highest adaptability or fitness within a context that is related to a specific project or a challenge that it tries to face. So I mean, diversification in this regard, when it comes to services offered by tokens, has to take into account there's different angles. We analyze each single project and each single network.
Thank you. Do you want to touch on something? No?
Yeah, I think if you look at diversification in service providers, it's always good to have backups, right? So if one service goes down, and I think what we've seen last Friday, where putting in orders into exchanges was quite difficult, then it pays to be able to have access to multiple providers. Also, when you touch upon custody, which is of course a very important part of the risk. Yeah, if you look at the FTX blow up in a couple of years ago, yeah, we've seen funds in the space that lost 30% of their coins on quite conservative strategies because they did their custody on the exchange. And I think that's a very, very important part to have that part covered well. So I think where it's possible, cold storage is very important, or at least have custody providers that yeah, manage those kinds of risks very well.
Thank you. And,
Yeah, completely agree. I mean, the worst thing that can happen is like you lose some of your clients' coins. So I mean, the best you can do is to make sure that the custody solutions are really in a good proper position. The beauty about the European ETPs is that they are not as concentrated in terms of custody as the US ETFs. The US ETFs, as you know, are pretty high concentrated in one single custody player, that it's Coinbase custody. In the European ETP space, you have a broadly more diversification between different providers like Zodia, BitGo, and so on. So we are really happy about that. But yeah, I mean, it doesn't. The strategy doesn't matter if you lose access to your coin or some exchange is hacked, for sure.
do you want to add something, Jennifer? No? We move on. So, okay. Then we got the liquidity in the market as well, which is another thing to look at. So when the correlation tell you like, okay, go in, but liquidity is telling you the opposite. How do you deal with that? Do you go to take some, because it's all about weighting, positioning, and weighting your bets and your allocation into the investments you're making. So how do you deal with the liquidity in the market? Who wants to start, Jennifer?
Well, one benefit of buying low and selling high is generally liquidity is coming in your direction. So we have, for those positions where we track how much depth is in the market at 1 to 2% of the current price, and how many hours or days would it take us to sell our positions. We do venture into positions where it would take us days to sell them, but only a couple. So we manage our liquidity risk that way. But there are certain things we hold in our portfolio in relatively small size, because I know in a market like today, they can't be sold at the price you see on the screen. There is not liquidity to sell them. So we have to, we hold through those things. We can't sell them. We have to sell those things.
Why you don't act with market maker to help you to get, to sell your coins, for instance? and go to see OTC deals and...
Yeah, we use everything. We use Coinbase. Coinbase has its own trading system. We can trade directly. We trade on OTC desks. We trade on desks that use algorithms. And for things that are relatively illiquid, where the liquidity isn't there for something you want to buy or sell, some of these desks, I think, we have tried them all, but some have very effective algorithms for long VWAPs, for example, or long buy or sell programs. And they seem to do that without affecting the price very much and still getting something done, but not always. You know, it's definitely a challenge on some days. And I think, you know, trying to sell things today that aren't the majors would probably be, you know, you're going to have a price impact, I'm guessing.
So yeah, you said buy low and sell high, which is something like timing the market, something very complicated. Yesterday was a low at 108. Today we are low at the beginning of the panel 104. Maybe we are lower now. I didn't have a look yet. And we never know when it's going to be the low and what kind of low it is. So what you guys are looking at, so liquidity is one thing, and the market is moving a lot when we got very little liquidity in the market. But so how you measure and you weight your entry points in the market? You want to?
I mean, from our perspective, liquidity is not a problem. There is no risk, no liquidity risk at all in crypto, in our opinion. Somebody has to say that in this panel.
I will have the devil advocate. You have some liquidity problem, like last Friday. You got some tokens who went to zero. So
yeah, but with liquidity, I mean, the moment you are properly managing the weighting in your portfolio, and the moment you have really huge and higher weighties in the biggest coins like Bitcoin, Ether, so on, and you have lower weights in the smaller ones, I think really liquidity is not really a problem, because somebody has to tell that, and somebody maybe is misleading this in this conversation. Here, some of the attendees that make sure that the lower liquid coin in our portfolio, it's more liquid than the best stock, one of the best stocks in the Madrid Stock Exchange here right now. So, I mean, I know that for sure it's not the same, the liquidity in the Madrid Stock Exchange that in the US markets. But I think really liquidity is not a problem if you really are managing well the weighties in your portfolio.
Thank you. So something we didn't touch on in terms of diversification is memes, zombie protocols. So which is also something which can return a lot of money. I won't say names, but maybe Jennifer, you want to touch on that, because we were speaking about it, and we can see like big outperformer, whereas they don't have real activity. When you look at coins, what you need to look at is the activity you got on the blockchain, if there is traction, if there are builders around, which problem are they solving? And some of them, yeah, are not, but they still outperform. And meme coins, they were doing quite well as well last year.
Yeah, this is a big problem, I think, for all of us. So, for example, Bitwise, Matt Hogan was here earlier. They're a tremendous firm. They run a bunch of, index crypto portfolios, and they curate them just like the S&P 500 is curated. So are these indices, and they curate them to exclude certain things, like Dogecoin, for example, is excluded from many indices, and we exclude it from our universe. But those tokens like Dogecoin have been tremendous winners. I would say we have excluded things like BNB token, the Binance exchange token, and Tron because of the founders. We don't have confidence in what we're getting and
Not
what
to be
they're.
political.
Yeah, I'm here. I'm saying it, but they've been really, really strong performers. There are things that we consider useless tokens like XRP, zombie tokens. In our view, no one uses XRP that I know of, but it did benefit from the whole stablecoin, narrative. It seems. I don't. That's my only explanation for why it goes up. Or maybe I'm dead wrong about it. But we exclude those things, and even though they're zombies, they can outperform Bitcoin, for example. So that thought process of like what's in the universe and what's out is a very important decision. And I think a lot of us are intimidated by standing in front of a traditional institutional investor and explaining to them why we own Dogecoin.
Thank you. Yeah, maybe a last word, every one of you, because we arrive at time. So let's start with Marco.
Okay, so I think that the take-home message here is that in order to have a diversified portfolio, there are different things that need to be taken into account. So it's not enough like measuring price correlation as we can do in traditional market, or looking also only to sectors and so on, because probably digital asset can be considered as a sort of a single cluster for some people, at least a level of perception. So when it's going down, most of them go down. When it's going up, most of them try to go up. So in order to build this diversification, there are different angles. And that's why, again, I think that this is important to analyze also human aspect, the human behavior that can be tracked on social platforms, like for instance Telegrams, X, and social media and so on, and try to capture the sentiment and the way people behave in this regard. And since we pay a lot of attention at Nodiens to risk, also to try to understand if there are some potential risks happening related to some tokens, specific tokens, and so on. So diversification is not that as simple as probably can be measured in traditional finance, and we need to be strongly aware about that and try to look at from different perspectives. Thank you.
Thank you. Let's make it a bit shorter, Rémond. Like 2 words to conclude, and then Román and Jennifer, please.
Yeah, I think if you look at diversification, there's multiple ways you can look at it. As Marco said, I think if you look at crypto, diversification of strategies is something that's very important. That's something that works. But as correlations tend to be very high, it doesn't make sense to have a lot of allocations to different projects. So, but also talking earlier about the custody part, very important part to take that in consideration as well.
Román.
Flexible crypto ETP. That's the way to have crypto in your portfolio. That's all.
Jennifer.
Buy Bitcoin.
That's very centralized.
Even
That's
better.
A good call as well. Thank you very much, everyone.
Thank you.
Thank you.